As per the studies, most first-time homebuyers will break a mortgage in 22 months. We are renting, but with the bank. The market will disintegrate if that happens. Fixed payments throughout the 5 years or whatever your term is. We need to fuck the system. Hey guys, welcome back to the channel. In today's video, we'll be talking about interest rates. That's the red hot topic right now. What Bank of Canada is doing, what we can do to fight interest rates, which interest rates to choose. We'll be talking all about interest rates today. If you're a first time home buyer or in fact an investor, this video is for you. So let's get started. Alright, so in today's presentation, we'll be talking about fixed and variable rates, pros and cons of each. I'm not the kind of person who will actually say that you should take fixed or variable, but sometimes it actually makes more sense mathematically to take variable, and we'll discuss that. We'll also talk about what's best for first-time home buyers and why. And then we'll also discuss about interest rate hikes and when will this madness stop, because we have seen that interest rates have actually grown despite Bank of Canada saying back in 2020 and 2021 that they'll not be increasing the interest rates by 2023, but we are still seeing a steep rise in interest rates, and we'll talk about what's going to happen next, or at least we can talk about what experts are saying what's going to happen next, and that will be coming by the end of this video. So first, let's talk about fixed versus variable rates, and first let's talk about what it actually means when it says fixed and variable. So when you are doing a mortgage payment, there are two components to a mortgage payment. One is the principal component, that's the money that you are putting into your equity, directly goes towards the equity, and the other one is the interest that you pay as part of that mortgage. And if you are talking about a fixed mortgage, what happens is, for instance, you're talking about a 5% fixed, your principal payment and your interest payments remain the same, and therefore obviously your mortgage payments also remain the same. But on the other hand, if you talk about variable, as the name suggests, as the interest rates go up and down, the interest components goes up and down. That's what a variable rate mortgage is. Now there are two types of variable rate mortgages. We'll talk about that as we go along the presentation. The main difference is fixed means fixed payments throughout the 5 years or whatever your term is, and the variable payment basically means up and down depending on what Bank of Canada is doing. Now let's talk about why do we even take variable, because fixed rate, because the payments are fixed, it actually makes sense to take fixed all the time. There are several reasons why you would take that. Let's take a real example of what's happening right now. So for instance, you were taking $500,000 mortgage today and you are contemplating whether to go for a 5-year fixed or a 4.5-year variable. I've assumed a 25-year amortization in both the cases and a 5-year term in both the cases, but this is real numbers that we are talking about here. And what would happen if your mortgage is fixed is that your year 1, year 2, year 3, year 4, year 5, but all the years on a monthly basis, you'll be paying $2,908 every single month for 60 months straight. So overall, you actually pay total mortgage of $174,000, roughly $175,000, of which the principal is only about $60,000 and the rest goes towards interest. So you are actually paying a lot of interest upfront. That always happens in any kind of mortgage when you're taking. You actually pay a lot of interest upfront, especially when you're buying your first house with a 25-year amortization. Let's talk about variable now. Now, assuming that the rate starts at 4.5% today, your mortgage payment will be close to $150 lower than your fixed payment, which is $2,767. But let's assume that now the variable payment has increased to 6.5%. I'm actually increasing an entire 2% more. The market will disintegrate if that happens. I don't think we are going to reach the 6.5, but let's just, for an example, take 6.5%. The mortgage payment will increase by a whopping $600 for this particular mortgage. It's really crazy. And then what would start to happen, again, I'm making assumptions, year 3, it's closer to the election year, there's a very high chance that the mortgage will come down again. Let's assume that it's still higher than what it is where you start. It's at 5%, so I've taken 5% variable here, and the mortgage payment will be about $2,908, which is equivalent to your fixed payment. And then it's year 4, it's 2025, it's election year, there's a very high chance that we'll go back to the 4%. Now 4% is not any number, 4% is the 25-year average of variable rates across the last 25 years, and it makes sense to take that number in year 4, and that will be $2,630. And in year 5, let's assume that we go back to the 5-year average of variable rate, which is 3.2%, and then the payment will be $2,418. If we include all this monthly payments by the year, and I'm taking a lot of assumptions here, but I've taken extreme assumptions as well of 6.5%. I don't think we are going to reach there. But the total mortgage that you'll be paying is $6,000 lower than if you were to take a fixed mortgage, and your principal amount will be about $56,000. So you're actually paying a little bit less principal, but you're also paying a little bit less interest, which is about $2,000. It's not the end of the world, to be honest, but the biggest difference between variable and fixed is not just this difference. Even if the variable mortgage interest was a little bit higher, which could be the case in some cases, depending on how big your mortgage is, it still sometimes makes sense to go for a variable rate, and I'll tell you why. Fixed is really very expensive to break. Let's understand how penalties are calculated when the mortgage is broken. Now first, let's understand who breaks a mortgage. There are three reasons main when first-time home buyers break a mortgage. Number one reason is you're upgrading your house. You're going to a bigger house. Now you're buying a 1 million plus house. Now you want a 30-year amortization. You bought an insured house at a 25-year amortization. So you're making a material change in your mortgage and you need a different lender or you need a different term. And that's where you actually break this mortgage, you pay off this lender and move on to the next lender, or you pay off this mortgage and take a new mortgage from the same lender. In all those cases, you are actually breaking the mortgage. Number two is that you refinance. You actually take out equity. So for instance, you buy a $900,000 house. Now it's grown to 1.5 million. You want 20% equity out of that house, whatever that number is, right? You need $200,000 out of that house. You can actually do that by refinancing if you income qualify, and that's called equity takeout. And that's another reason why a lot of people break their mortgage. And the third one is if you win a lottery and then you don't care about penalties, so it doesn't matter whether you are on a fixed or a variable, but most of the people will actually break the mortgage for the first two reasons, and the lucky ones will get the third reason as well. But yeah, if it's a $500,000 mortgage, if you're on a 5-year fixed versus a 4.5-year variable, let's talk about if you break the mortgage in 2 years. Now, why did I take 2 years? As per the studies, most first-time homebuyers will break a mortgage in 22 months. That's about 2 years, and your balance, let's say, is $475,000. You have paid down about $25,000 in about 2 years. And let's first take how much penalty you'll be paying on a variable rate. So it's 3 months of interest rate. That's straight up. Most good banks will actually have just 3 months of interest rate payments. That basically means if the interest rates at that time when you're breaking the mortgage is 4%, it will be 4% multiplied by 475, which is your outstanding, divided by 4. Because 4% is for the entire year, you're only paying 3 months. So that will be divided by 4. And the penalty will be less than $5,000. Now let's calculate what happens in fixed rates, and fixed rate is actually called interest rate differential. That's how the penalties are calculated. Now, for instance, if you had a 5% fixed mortgage for 5 years and you are breaking in 2 years, and at that time, at the time of breaking, your fixed rate is actually 4%, what would happen is that you'll have to pay 1% differential, which is 5% minus 4%, into 475,000 multiplied by 3 years. So you're paying the interest rate differential of 1% for the entire 3 years, and your penalty will be almost 3 to 4 times of your variable rate penalty. And that's how the bank actually makes a lot of money, because they know as a first time home buyer you will break a mortgage because you would want to upgrade and you would want to refinance, you will want to take equity out and invest somewhere. So for most first time home buyers, at least who are my clients, I always recommend, I do this calculation, I always recommend that you should go for a variable rate mortgage if you are planning to break a mortgage inside the 5 years. Now, I don't want to totally disregard the fixed rate mortgage. There is a place for that, especially in today's world, because the interest rates are very high. So let's talk about why do we take a fixed rate mortgage. Number one is, and that's the biggest one, it's peace of mind. You know that the payment will be fixed for 2, 3, 5 years, whatever term you take. You know that you are liable for the same amount every single month without it being going up or down, and you can stop seeing the news, which in my view is any which ways biased towards banks. Let's talk about the second reason, which is you are 100% confident that you're not going to break in 5 years. Some people are, some people aren't. But fixed rate mortgages do not give you the flexibility to change your mind midway. You'll actually be paying a lot more penalty if you do that, like we saw in the last slide. The third reason is that it's a rental purchase and you need steady cash flow. That's one reason why a lot of people actually go for fixed mortgages. Again, variable rate mortgages are equally good for rental purchases as well, but sometimes it actually makes sense depending on your situation, whether a fixed rate mortgage will be good for you or not. And the fourth reason is that you can no longer make the payments on your variable rate, and therefore switching to a fixed might make sense. So for instance, if you are at 4.5% variable now or 4.2% variable after all the rate hikes, and you're like, I can't take another 1%, I can't take another 0.5, I'm actually at my max. That's where you can actually move to a fixed rate mortgage, and you can call the lender and move to a 5-year fix. Now that also means that you'll lose the flexibility of breaking the mortgage, but it actually gives you a temporary relief, and that's sometimes important. And the fifth point is you do not qualify with a bank, and most B lenders, which are, I like to call them alternate lenders because there are actually good options available right now, especially with the interest rate so high. If you do not qualify for a bank, the B lenders do not provide, most B lenders won't provide a variable rate mortgage, so you'll have to go fixed, and there'll be other terms as well attached to it, but there are good options for certain cases. So do book a call with me if you are planning to buy a house and you're not qualifying with a bank. Now let's also talk about the rates a little bit, because banks actually are playing with our psyche and we need to understand, and therefore it's important to talk to a professional when we are talking, because if you're talking to a bank, they will talk about a script that they have been told. But if you're talking to a mortgage agent, and a good mortgage agent will be able to guide you. And let me now simply break down how the pricing actually works, how the interest rates are actually structured right now. So for instance, the 5-year variable rates right now, if you're buying an insured property with a less than 20% down, is 4.55%. It's 4.5 to 4.55%. And if you go for a 5-year fixed, it's actually not very far from the variable rate mortgage, which is 4.59. So you might say, oh, wow, that's amazing. You know, it's actually very close, and let me just go for a 5-year fixed. But the problem then is, and you know, your devil's advocate will say, oh, if I go for a 5-year fixed and in 3 years, if the interest rates start to come down, I lose the flexibility, I'll be paying a much higher interest rate. So let me not do that. Now, the other thing is, and that happens a lot, right? That's very natural. You would say, oh, let me just go for a 2-year fixed or a 3-year fixed. And the problem with that is that the 2-year fixed or a 1-year fixed is actually much higher at 5.39%. So the bank actually knows, and that's called anchor pricing. They actually give you a very high interest rate at 1 and 2 years, and they actually want you to lock into a 5-year fixed because it's looks a lot better than at 1 or 2 year fixed, because the banks, with all their intelligence and knowledge and economists that are, you know, guiding them, they actually kind of know that in 1 to 2 years the mortgage rates will start to come down, and that's where they'll make a lot of money when people break the mortgages. And even if you are fixed for like 5%, they will actually make a lot of money, because the actual fixed rate that they are paying to Bank of Canada is actually much lower than 5%, and therefore they make more money when the differential happens. The 3-year fixed right now is also very high at 5.04%. So you can, if you want to get that peace of mind, I would still recommend you go for a 3-year fixed and not a 5-year fixed, even though the 5-year fixed looks a lot better. Now, this is a very typical marketing strategy. Now, I'm a marketing guy and I know this strategy very well. You must have seen this in Starbucks. For example, you have a tall, grande and venti. It's priced at 2.95 for the tall, 3.65 for the grande and 3.95 for the venti. What happens is, for that 25% extra, you are like, oh, I'm only paying 30 cents. And this basically is called value-based pricing, and that's what they are doing with this. Now, one thing that I know, and I've been in this industry for 1 year, I've bought houses, I know one thing for sure, and I even own shares of banks, right? So they never lose money. Especially in Canada, it's so risk averse for the banks that even if the market is going haywire, they'll still make money in interest, and that's what happens. So one thing that you can never do is you can never beat a bank. The bank always makes money, and that's what's happening here. Now that I have semi-convinced you to take a variable rate in any situation, even though I really feel that you should talk to a mortgage agent, there is a place for fixed interest rates. Not all my clients are on variable, right? There are some clients who are on fixed rates, and there's a place for that. But there are two types of variables, and we need to know both these types of variables. When the interest rates were lower, no one was talking about these two types of variables. But now that the interest rates are higher, everyone is talking about this. But let's just talk about who is each of these interest rates for. So there are two types of variable rate interest rates. One is the adjustable payments. The other one is with fixed payments. What I mean by that is, for instance, if your mortgage payment is $3,000 and your principal component of the mortgage payment that we discussed in the first slide is $1,000 and the interest component is $2,000. This is just a random example. It's not exact maths here. What happens is, if the interest rate actually goes up by 0.25%, and if that dollar equivalent is $200 of more interest that you need to pay every single month to the bank, what happens in the adjustable payments is that your interest increases by $200 and your overall mortgage payment increases by $200 as well, and your principal payment remains as is. So you keep on paying the $1,000 in principal and keep on buying down, or paying your mortgage down by the same amount that you started with, and overall payment actually increases by $200, which is the interest rate increase. What happens with fixed payments is a little bit different. Interest rate obviously increases by $200 because the bank never loses money, so they will take your interest. However, they will take that from your principal. So instead of giving $1,000 in principal, or instead of paying your mortgage down by $1,000, now you'll be paying your mortgage down by $800, and therefore your overall payments will actually remain at $3,000. Now, it's not always a bad thing to take the fixed payments, but there are certain rules that I adhere to and it makes sense mathematically. So for instance, if you are doing less than 20% down, if you do not have enough equity in the house, if you are looking for the best interest rates, because what happens is the adjustable payments actually come with almost 0.4 to 0.5% better interest rates. If you are looking for all that, I would highly recommend you go for an adjustable payment, because it's very important that you pay down your mortgage pretty quickly, especially if you are buying your own house. It's an owner occupied house. The habit should be to pay your owner occupied house as soon as possible. You should not be waiting for 25-30 years to pay it down. You don't want to be 65 and 70 and still paying the mortgage on your primary house. So the intent should always be to go into adjustable payments, especially if you do not have enough equity when you start with and you're doing a less than 20% down. Now, if you're doing a more than 20% down, or you're buying a rental property, or you're doing a HELOC, it's okay to go for a fixed payments. That's what I recommend clients. If you are doing 20% and plus down, I do give an option of going and fixing payments with lenders like TD, CIBC. A lot of banks actually do that. But if you are not doing a 20% down, I always recommend people to go for adjustable. I have both the options, but there's a logic for that. Now, let me just explain what happened with a lot of people, and a lot of people actually watching will resonate with this. Now, the thing that I don't like with these fixed payments is what happened in the last 1 year. For instance, someone actually took a mortgage, say in December or January this year, for $900,000. They made the minimum down payment of $65,000. Their overall loan was $868,000. So just imagine you only have $32,000 of equity in the house. So you took the interest rate 1.5%, your mortgage payment was 3,471. It was all amazing until the interest rate started going up. Your payments were fixed. Banks started taking money from your principal, and what happened was, right now people are actually not paying anything towards their principal payments. And what's worse is, because the house values have come down, the house is now worth a lot less, and you do not have enough equity in the house. In fact, you have negative equity in the house right now. So what's happened with these mortgages is that there's no equity in the house and there's no principal pay down happening, and that basically means that we are renting but with the bank. And you were renting at $2,500 paying someone else's mortgage. Now you're just paying interest to the bank, plus you're paying property tax, plus you're paying utilities, plus you're doing the maintenance of the house. And that's, to me, is a really bad deal. And therefore, if you do not have enough equity in the house, always default to adjustable. Adjust your price, not your interest rate. It's very important to understand that. Adjust the price that you're buying. If you want to buy a $900,000 house, and if you're going for fixed payments because you're getting a better interest rate and the payments will not increase, that's not the right approach. You should think of buying a $750,000 house or $800,000 house, upgrade to a $900,000 house in time, and take the adjustable payments, because that would ensure that you pay the principal and you're at least paying down your mortgage even if the interest rates are going up. Now guys, this is just my point of view. I am a mortgage agent. I actually see a lot of people making a lot of mistakes. I see a lot of people actually doing the right things. I see a lot of people who are very smart actually understand that adjustable rate is better for them because they will at least be paying down their mortgage. I think all that is really, really important. However, in today's time, you do need to talk to your expert. If it's me, I'll guide you. If it's someone else, ask them what's best for you. Do the calculations, open an Excel. Even if you don't like the maths, do the maths. It'll help you make the right decision. Now let's talk about the hot thing. When will this madness stop? When will the interest rate start going down? And the answer is no one knows. And I'll tell you why. What happened is, the reason why we are in this situation is because a lot of money was printed in COVID. I've actually talked about this in my inflation and recession video, and we had over $500 billion in the economy, whereas an average has been about 100 billion. So M1 cash is about 100 billion in the economy. That's the amount of money circulating in the economy. It certainly increased 5x. And now with all the interest rate increases that have happened, we have actually pulled out, the government has been able to pull out $200 billion from the market. by making things unaffordable, and we are still not yet in the recession. We still have 3x more money in the economy, but I would say that in the last 1 year the government has been able to pull a lot of money out of the economy, but the inflation is still at 7%. Now, one thing that we know for sure is that all the sanctions that were put on Russia with what they did with Ukraine, all that has impacted the oil prices. The oil prices right now are subsidized by a lot, and the reason for that is they want to get the food inflation down, because if the oil prices are up, the food inflation has to go up because transport is expensive, everything is expensive, and with all the supply chain issues that we had through COVID, this is actually putting a lot of pressure, and I don't see how we are actually not going to go into recession, and we'll actually be forced into a recession because of a simple phenomena that I discussed in my video on recession, and we are actually seeing that happening right now. What happens is, let me just reiterate, what happens is that when the inflation is high, which it is right now, you have to increase the interest rates because you need to reduce the demand. What happens when you increase the interest rate is that borrowing capacity, not just for houses but for businesses, also goes down. The cost of borrowing goes down, the amount of money that is available to be borrowed goes down, and therefore consumer spending also goes down. Because the houses are more expensive, renting is more expensive, food is more expensive, the consumer spending has to go down because they have to budget, because salaries are not increasing at the same rate. And the other thing that happens is, because there were so cheap loans available for the businesses expanded too fast, too quickly, and now that all that funding is cut off, or it's become very expensive because the borrowing rate has actually gone up because of the interest rates, it's really difficult for the businesses to actually grow, and we see a lot of businesses actually declining right now, just like they did in COVID, and the economy is suffering. And that would have a direct impact on layoffs and unemployment. We saw the numbers, it's over 5% now. It's only going to get worse with all this situation. It's just a cycle, this is the economic cycle of a recession, and it will keep happening till the time demand is less than supply. It's all about demand and supply, and this cycle runs on demand and supply. Through COVID, because there was more money in the economy, there was so much demand that it outrun the supply, and therefore everything went so expensive, and now they need to reduce the money in the economy so that people actually get laid off. And now with the government pulling out money from the economy, the businesses will suffer, and therefore unemployment will increase, and therefore the demand will reduce, people will be spending less money, and therefore again we'll have a balance in demand and supply. And what would happen is that we will actually see this money go down, the supply go down, and then the inflation will become lower. It has to come less than 5% at least to see any kind of interest rate reliefs, and then the interest rates will start going down, borrowing capacity will increase, consumer spending will increase, because now the housing will become a little less expensive, the borrowing will become a little less expensive, the businesses will now again have access to cheap money because interest rates are low, and the layoffs and unemployment will reduce. The unemployment rate will again start to come down because now the businesses can actually invest in people again. And this is where us going into a recession is actually a cure, and the government and Bank of Canada is pushing us into a recession in order to take us out of this mess that we created by printing more money. What the experts are saying on interest rates, and again, I would not go by what the news is saying, purely because the news is actually influenced by what the banks are saying. All the economists are influenced sometimes by what the banks are saying, because again, bank never loses money, but we might see another 0.75 to 1% increase. That's what is being going around and being talked about. It will hold at that level by the end of 2023, and then it will start to come down. So we can expect the interest rates to go up a little more, and then they'll hold for an entire year, especially 2023. Now, there are a couple of reasons why I think the interest rates will start going down in 2024, and that's because with all this supply being cut off, there will be inflation control happening. I think we'll go below 5% on inflation. And the other thing is politics. In an election year, which is 2025, 1 year before that, I think they would want the interest rates to be low and the market to be stabilized again. I can actually talk on both sides of this. Yes, probably the real estate market will actually start to come down or continue to go down, as we have seen in the last 6 months. Again, we are not talking about 2022 versus 2021. It's not a like-to-like comparison. We are actually comparing against January, February, December, the craziness in the market that we had. Now, that's not the right comparison. If we look at from last year, it has still increased by over 10%. But let's assume that it actually starts to come down more and more, and we are actually in the negative while we go into 2023. Now, there are certain reasons why I do think it can happen. And number one reason is that there could be, because of the higher unemployment rate, there could be more foreclosures and more, properties coming onto the market. So the inventory may go up and there'll not be enough buyers because the affordability is actually low with the buyers. More forced selling if the business is shut down during recession. That's a real scenario with all the inflation that is happening, with the cost of borrowing being so high, with the consumer spending being so low. Businesses will suffer, and all those business owners will sell their investment properties or will be forced to sell their investment properties because they want to keep their businesses afloat, and therefore it will increase the inventory in the market. And the third biggest reason is the interest rates are so high that there are less buyers qualifying for the house. Not because the house prices are high, house prices are still low, but the interest rate, because of the stress test being plus 2% or whatever the interest rate is, people are now qualifying at 6.57% stress test levels, which a lot of people are not able to do. Now, if the unemployment and the recession doesn't go as bad, what would happen is that the rents are so high right now. That's something that we cannot debate. Rents are high because a lot of people, a lot of buyers who are going to buy in the market, they are actually scared of not qualifying, and therefore they are also renting. With more people coming in, the rent demand is actually very high. We already have a housing supply shortage. That's something that the government has already admitted for many, many years now, and therefore the businesses who actually own the investment properties or people who are not able to sustain their properties, they would continue to rent their properties because rentals are so high, and they'll just want to see this through. The second reason why I think it probably would not crash is that because of the rents being so high and people wanting to see this recession through, there will be very low inventory if the sellers want to hold. And even if there are less buyers, if there's less inventory, there's again a balance, and therefore we can see a balanced market. And therefore I feel because of the supply shortage mostly, there's a high chance that the market will not probably crash. It will probably correct itself a little bit more if we see the recession being a little bit severe than what the government has been saying. But again, I don't think it's gonna crash, but it can sure correct depending on how bad the recession is. So the question is, what should we do? And I've been saying this even when I was not a mortgage agent, when I was buying my own property, I've been saying this: you need to buy with a rule of 35. Rule of 35 is that your overall cost of owning the house should not exceed more than 35% of your net household income after taxes, the money that comes into your bank account every single month. Now I have a calculator. You can actually download that from the description. And if you input your net income, net household income, let's assume it's $10,000. Let's assume that you're not getting a hike in the next, 12 months. Let's assume that you have $60,000 of down payment left and you do not have any emergency fund. So this is all the money that you have, $60,000, plus closing costs. And assuming that you are buying a freehold property and it's not a condo, you can buy up to $650,000 or just over that. And this is the rule of 35 because the cost of borrowing, the overall cost of owning that house, including the property tax and other expenses, including the mortgage, is not more than 35%. Now this rule of 35 is actually built based on a 3.2%, which is a 10-year average of variable rate, which is 3.2%. Now that doesn't mean that your actual mortgage payment will be $33,000. It will be slightly higher, but still it will not be as high as the bank actually qualifies you, because same numbers, if you give it to the bank, they'll actually qualify you for almost $750,000 to $800,000. And that's where we actually can go wrong. So let's go back to our slides and talk about how these numbers stack up. $650,000 house, that's for a household that's earning $10,000 a month should buy. 10% down. Let's assume that you take a loan of $600,000 or just over it. What would happen is if you go for a 4.5% variable, I hope I was able to convince you that variable rate is still the best rate for you. But if not, let's have a chat. There is a case to be made for a fixed rate, and if it's best for you, we'll go for the fixed. But assuming a variable rate of 4.5%, let me just explain the table. In year one, with a 4.5% variable rate, your mortgage payment will be about $3,300. Your other expenses, which include your property tax and your other expenses of utilities, will be about $500. Let's assume that. Your overall home expenses will be about $3,800, and your net household income is $10,000. You have your overall house expenses to your household income at 38%, which is very, very comfortable. You're actually not stretching yourself. If you are buying a $750,000 or $800,000 house, which the bank will actually allow you to buy, you would actually stretch yourself to up to 45-50%, sometimes even 55% of your household income if the interest rate starts going up. Now, what would happen in year 2, 3, 4 if the interest rate go up and down? Let's assume again the calculations that we took in the previous slide. Let's assume that the interest rate actually increases by an entire 2%. Again, it's very unlikely that's going to happen. And if it does, the market will disintegrate completely. Your mortgage payment increases by about $7,000. Your other expenses remain the same. Now, this is still not very crazy. It could have been a lot worse. A lot of people are actually now in a situation where they are paying 65% of their salaries because they got a mortgage at 1.5% and now their mortgage has increased. But for you, if you're bought at a rule of 35, that will not happen. And if the interest rate now goes down to 5%, you are now spending 40%. Now, if the interest rate goes down further to 4%, which is a 25-year average, and 3.2%, which is a 10-year average of variable rates, you pay less and less. And of course, I've assumed that the net household income remains the same. Obviously, it will grow every single year and these percentages will drop. But again, it's really important to buy with the rule of 35 or at least the rule of 40. Not more than 40% of your income should go towards house. And if you do that, even if the interest rates go up and you take a variable rate mortgage, you'll be okay. But if you extend on your budget, if you buy more than what you can afford, I promise you this, if the interest rates start to go down, you will struggle. Now, I've been talking about interest rates for about 20 minutes and I see a lot of people actually get obsessed with interest rates. But to be honest, no one ever became a millionaire by getting a mortgage with a 0.5% lower interest rate. I've never seen any millionaire or a billionaire who has made their money by saving interest rates. That's just a fact. And therefore, we need to change the narrative. We need to fuck the system. And I cannot put it mildly because what happens is, and that's what I don't like about the system, the bank never loses money. We talked about this. They'll always make it a point that they actually earn more money off you. Bank of Canada prints money at will and then raises the interest rates, puts us into a recession, and then the government will raise taxes and then decide when we go into a recession. And all this is actually meant to fuck us. We need to change the narrative. And what I mean by that is we need to learn a skill so that we can get extra dollars, and whatever interest rate increase has happened and whatever payment has increased, we are able to offset that by the additional income that we are getting. It's really important now more than ever that we actually start developing a skill that can actually get more dollars into the bank, and then we don't have to worry about the interest rates and what's happening there. Buy what you can afford, not what the bank qualifies you for. And that's why I created the rule of 35 calculator. I can actually do the calculations as per the bank. I do that for my clients. I actually do both sets of calculation, rule of 35 calculation and the calculation that the bank will do. It's really important that you do those calculations, and then you need to invest. And that's the only thing that will put us ahead when we are retiring. We need to invest whatever we are making additional, and if we don't buy more than what we can afford, we'll always have a budget for investing. And these are the things in green that we can actually control. We cannot control the red things. It will continue to happen. We can either crib about it or we can change the narrative and do what we discussed in the last 3 points which are mentioned in the green. It's really important that we change the narrative because system is not going to change. That's all I have for today. I hope you liked this video. The video went a little bit longer than I expected, but it was important to discuss interest rates. It was important to discuss what's going to happen in the future. What are the experts saying? I'm no expert, but I can surely help you with your mortgage decision. I'll surely help you make a decision on whether to go for a variable rate, fixed rate, 5-year, 3-year, all those calculations. I'm a maths nerd. So if you're not a math nerd, reach out to me. I'll help you do the maths. If you're a math nerd, you'll actually like talking to me because in reality, I'm a bigger math nerd than what I show on YouTube. So I look forward to talking to you. Do share this video with your friends and do subscribe to the channel if you have not done that. I'll come up with more detailed videos on different aspects of home buying, investing, crypto. A lot is gonna happen on this channel. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।